Thanks to everyone who's joining us from the waiting room. We appreciate your patience and we'll get started right at the top of the hour. Thanks again to the hundreds of people who have joined us for today's webinar. Today, the American Ambulance Association's experts, Asbel Montes, Brian Werfel, Scott Moore, and Wayne Jurecki will join us for this live emergency session. Asbel, Scott, Wayne, and Brian will break down the newest announcements from HHS regarding provider relief for EMS. After their timely and thoughtful analysis, they will include plenty of time for your questions. Scott, would you mind going one slide forward, please? To continue valuable EMS programming like this, we request your continued support of AAA membership. New for 2020, AAA membership will include free access to the American Ambulance Association virtual conference. All members will be registered automatically at the end of October. Additionally, in 2020 and 2021, the American Ambulance Association will include virtual copies of our ebooks, including the Medicare Reference Manual, with your membership. So you'll be able to quickly and easily download PDFs of these valuable publications. Would you mind moving forward one slide, please? To ask questions of our experts today, please use the Q&A function represented by the double dialog box. The chat box, represented by a single dialog box, is where you can share peer-to-peer comments or ask for help with technological difficulties. Next slide. As with any webinar, today's session does not constitute legal advice. Of course, please consult your own counsel if you have any specific questions. With that, it is my pleasure to welcome Asbel Montes, AAA's Payment Reform Chair, this morning. Asbel, would you please kick us off for today's session?
Hello, folks. Well, we're glad you're here and joining us. We do have quite a full house, as Amanda indicated, as we kind of expected to happen. So this is great news for the industry that there is a third general allocation. And it has been a lot of advocacy that has been done on behalf of the American Ambulance Association and many others, really bringing relevance to the plight of the ambulance industry. But today, with Brian, Wayne, and Scott, and we're going to kind of walk you through what to expect as well from our perspectives and from the perspective of EMS and what you need to be prepared for, kind of broken down. Pay close attention to the formulary and how the formulary is going to be calculated. Remember, while you are being urged to try to apply as soon as possible by HHS, applying too quick is not the best formulary if you don't have all the data together. So pay attention to some of that as well, and we will interact. Q&A is your friend today. So the very bottom, make sure you click on the Q&A, and we are going to answer these questions live. There is no question that is dumb at this point in time. If you don't know, ask it anyway, and we will try to opine and make sure you either get the information or it gives us a list of questions that we need to follow up with the administration as well. So I'm going to turn this over to Scott, and we're going to go through as an anecdote, folks. I'm somewhere where my internet is not as stable. So I am going to make sure that you get all the information as possible through the process. But we're excited about this. This is a good thing for most everyone that is viewing this today for the industry as well. It's not particularly what we were advocating for up that $2.86 billion, but it is a portion of that. And we will continue to keep advocating to make sure funds get to the EMS entities and those that are on the front line. So Scott.
Thank you, Asbel, and thank you everyone for joining us this morning. I know there's a great number of you, one of our better attended webinars. I want to thank the other presenters, in particular, Wayne Jurecki, who always jumps out in front and offers to help and make sure that sort of he usually acts as the guinea pig for going out and applying for these things and then taking screenshots to make sure that he helps the fellow members in the association. So thanks again, Wayne, and we'll hear from him a little bit later. But as many of you know, of course, we are in just the craziest time that we could have possibly seen over the last year. If you asked anyone a year ago if they could have predicted this, I think that would be amazing. In any event, of course, we had the public health emergency that was declared back in January, extended in April. And while it says expires, well, it actually expires right now as of after the election. We think somewhere around possibly January 23rd, although it could be ended earlier, but it was continued. It was set to expire back in October, and now it has been continued. So we've seen a fair amount of new legislation and regulatory action in an effort to sort of help healthcare providers to not only offset any losses in revenue that they experience, but also those additional costs as a result of responding to the coronavirus. So we had, of course, the CARES Act, which was passed back in March. The Families First Coronavirus Response Act was passed also in March. And then, I'm sorry, actually, we had the Coronavirus Preparedness and Response Supplemental Appropriations Act passed before the Families First Coronavirus, then the CARES Act later in March, and then the Paycheck Protection Program Enhancement Act in April, and then the Flexibility Act in June. So I don't think we've ever seen that many pieces of legislation get pushed through so quickly in an effort to try to respond to the pandemic. And for a lot of folks, we're still waiting to hear about what might be another relief package that comes down the pipe. And I know that's still being negotiated. Of course, for many of you, you are aware of the previous tranches of funding that were released. But what we found late last week, it was announced that HHS is releasing an additional $20 billion in funding through HRSA to try and get anyone or any provider who hadn't already been brought to that 2% annual patient care revenue number, to try and get those folks up to the 2% number. And then, and we'll describe this in more detail in a little bit, then get, if there's any money left over after that, gross up to that 2%, then the money will be distributed equitably amongst the other providers. So for anybody who, it's important that in tranche one, you had to do nothing. You just simply got this money deposited in your account. Tranche two, you had to apply. And we heard from a lot of folks, I applied, but I never heard anything. And that's because it's entirely possible that you already received at least 2%, if not, and we heard from some members who got a little bit better than 2% of their patient care revenue. So you likely wouldn't have gotten anything in round two. But it's important that even though you didn't get anything in round two, that you must or should apply for round three, because if in fact you just got your 2% and you didn't get any funding in round two, or even if you did get funding in round two, you might be eligible for additional funding if in fact after they gross all of those healthcare providers up to the 2% number, and there are still funds left over, there will be an equitable distribution. So today is the day that you can apply. The application portal opened up. However, even though HHS is recommending people apply early, if you are below the 2% number, then it does make sense for you to apply early. But if you haven't yet, if you've already hit that 2% number, really, we're not certain that there's any benefit in you jumping out in front and trying to get on that portal today. We imagine it'll be pretty busy. So I'm going to pass it off to Brian Werfel, who is going to run through this next slide, just to talk, actually the next couple of slides, to talk a little bit about the methodology and the formulary for the release of these funds. So Brian?
Sure. So I think the starting point will be the eligibility criteria. So in order to be eligible to participate in round three, you must meet a number of characteristics. The general eligibility criteria is that you are a provider that has either previously received a distribution of general allocation funds out of the larger HHS Provider Relief Fund, or you rejected the payment for whatever reason at the time. Maybe you didn't think you met the eligibility criteria. Maybe you didn't think you needed it, but situations have changed and now you'd like to participate again. So the idea with the first 2 rounds was to give every eligible provider an amount equal to 2% of their patient care revenue. So in this round, you'll be submitting to determine whether or not you've met that criteria, meaning are you already at 2% of your net patient revenue, and then to see whether or not you're eligible for the add-on to the extent there's any money for that equitable add-on that Scott referenced. Now, in announcing the round 3 eligibility, CMS went out of its way to encourage behavioral health providers, including those that received previous funding, to apply. So that seems to indicate that they suggest that those, or that category of providers, were underrepresented in the earlier rounds. And this will also include those providers that weren't eligible for the first 2 rounds because, for whatever reason, they first began providing healthcare services in January of this year. Those providers would not have been eligible for the previous rounds simply because the eligibility criteria required that you had, well, basically patient care revenue in 2018 or 2019. And this is also going to include dentists, assisted living facilities, and again, singling out those behavioral health providers. So this is a big tent distribution. So in round 3, HHS is trying to accomplish 2 different goals. And it's important that all of us understand the broader goal, just because it affects the amount of money that'll be left for us. So their first goal is to ensure that all eligible providers that submit applications will receive up to 2% of their patient care revenue. So anyone that through rounds 1 or 2 received less than 2% of their net patient care revenue will be grossed up to that amount first. And then to the extent any, those monies will be debited from the 20 billion. And then to the extent that any balance remains, they will take that remaining money and then equitably distribute it to all of the eligible providers. So there's sort of a 3-step process. Scott, can we skip forward a step? Whoop, 1 step, thank you. So during the submission period, HHS will get the applications from all those providers that intend to participate. And for each provider, they will first confirm whether or not that provider has received 2% of its patient care revenues for the targeted year. And to the extent they have not, it will then allocate money necessary to gross them up to that 2% number. So that's the first step. The second step, Scott, can we advance one? Thank you. There we go. They will then sum up all of those gross up payments, figure out what that number is, and then debit it from the 20 billion. And that leaves an amount to be then distributed to everyone else in the equitable add-on. Step 3 is likely where all of you on this call will start to participate. So they will calculate, and this is straight from their release, they will calculate an equitable add-on for each provider that considers the following. And it's the provider's change in their operating revenues from patient care, their change in it should be operational expenses from patient care, including expenses incurred related to the coronavirus, and also taking into account the monies they've received in the earlier rounds 1 and 2 of the general allocation funding. So we've put together a handful of examples here that'll just walk you through the best case, the worst case, and what we believe is likely a middle case and a more likely scenario. So the first situation that they, or scenario that we're describing is one where after every eligible healthcare provider submits its information in this round 3, it's determined that every provider has already received at least 2% of their net patient care revenue. And as a result, no additional gross up payments are required. This is the best case scenario for those of you that are on this webinar, because that means the full $20 billion is available to be distributed as an add-on payment. So after round two, Scott, can we stay put for a second? Thank you. After round two, CMS or HHS, excuse me, set its target percentage at 2%. What they're going to do with that $20 billion is create a new target percentage for everyone. And we've run through the math here. So if $50 billion, the amount of the initial rounds 1 and round 2, was enough to get everyone up to 2%, then an additional $20 billion would represent 40% of the 50 billion, and it would represent 40% of that 2% initial target number, meaning they would have enough to take everyone up to 2.8% of their patient care revenue. So that's best case scenario. Worst case scenario, after they gross everyone up to 2%, there's no money left over. The target stays at 2%. The most likely is some situations that we're going to land somewhere in the middle. So in the example we've given, they need 10 billion to gross everyone up to 2%. That leaves 10% to distribute. Now, what that means is that it took a total of $60 billion to get everyone to 2%, meaning the additional 10 billion is not going to be enough to take anyone up to 2.8%. Rather, it would add, 10 billion equals 16 2/3% of 60 billion. 16 2/3% of 2% is 0.33, which would come up with a new target of somewhere around 2.33%. So again, that's their aspirational target. If, depending on where they land on the gross up payments, we think that we're likely going to be somewhere in this range, as opposed to the worst or best case scenario. So start thinking somewhere in this 2.3, 2.4 range based on what we're hearing so far. All right. But again, that's the target rate. There are some limitations. So if we advance one slide, as of today, this is what we believe CMS, HHS, means when they say equitable. What we think is that they will provide each provider that submits an application an amount that's equal to the lesser of either one, the amount that would take them up to the new target amount, taking into account the amounts that they already received. So if you received 2% and the new target number is 2.4%, they will give you an additional 0.4%. But if after rounds 1 and 2, you got 2.1%, right, you'll only get 0.3% again to take you up to that new target number, right? But it will also be limited by, and this is where the reporting in this tranche 3 comes in, you will not be in a position to receive amounts that would put you over the amounts you're reporting as your decline in gross operating revenues, or the increase in your net operating or your gross operating expenses related to the coronavirus. In other words, their goal is to ensure that no one is better off as a result of the pandemic than they would have been had the pandemic not occurred, and then to make everyone equal within that threshold. So I think that's the formulary.
Yeah. Brian, we just had a couple of questions. And so really what you're saying is we really don't know. So we're not really sure where the number is going to land. The goal is to get people to 2%. If many of the providers that we spoke with actually got a little bit over 2%. So we're going to have to wait and see. And we should have, or may have some ideas sometime around Thanksgiving. But we had a bunch of questions that I'd love to run through if we could. So if a provider rejected round 1 and 2 and billed accordingly, i.e. billed COVID patients for out-of-pocket costs, but wants to apply for round 3, would those terms and conditions be going forward or apply retroactively? I don't know which one of you wants to field that.
It's a really interesting question.
Brian, if I can interject real quick on that before you get to that. The attestation form as it's currently described on the HHS site would be indicative that it would be retroactive. That is a very good question that will need to be clarified by HHS, of which we will do. But currently, as it is currently indicated on the website under the phase 3 funding, the general attestation form that you will sign is currently the general attestation form that has been signed for phase 1 and phase 2, which would be inclusive of anything that you did from January of 2020 to current. But that is a good question because of all the billing that's happening. I'm sure this has to do with the surprise billing side. I'm just surmising that this is what that's about, and we will need to get clarification on that because I cannot imagine that they're going to make you go and undo some things, as that would be an administrative nightmare.
Yeah,
Is what I'm assuming
that's
here,
a
Brian.
fantastic question.
Yeah, and the only thing I would add would be that in that scenario where you rejected the round 1 and round 2 payments, in making your calculation as to whether or not you would want to apply in round 3, you would also need to keep in mind that you would get the full 2% as part of submitting in round 3. So it's not just that additional amounts we're talking about. You would get up to 2% and then potentially more so. So it becomes quite a calculated calculation for that provider.
Well, and then we had another question, and this one's pretty straightforward. Is the 2% based on gross or net patient care revenues, and the numbers are gross, right? So
Yeah,
right, indeed.
It's based on your patient care revenue. So we do need to be a little bit careful because the terms gross and net, when we're talking about revenue in these contexts, mean different things in different contexts. This would be all revenues that were taken in the door that are directly related to patient care services that you provide.
Yeah. Okay. And a couple more questions. So I'm going to keep going. If a provider received 2% in round 1, and in comparing 19 and 20 patient care revenues, how should growth in the business, in other words, new 911 communities, be accounted for? So should new business be excluded, or is HHS doing a calculation strictly off the 18 and 19 reported revenue on tax returns? And my understanding in this instance is this is where that worksheet form 15 would be filled in. So if you had an adjustment to your reported revenues from whichever year if it's 19, if you're supposed to utilize your last filed tax year, so, and you will have to submit that tax return from the last filed tax year. But if you've had an adjustment in revenues, you need to complete what's really form or what field 15, which is a worksheet that is embedded in an embedded link that you can pull down on the HHS website. Guys, did I say anything? That's right. That would be how you'd account for that change. And then how will we report our revenue, since most of us saw a significant drop in revenue in March and April, right? And that again would be if you've had a substantial change in revenues from the tax return that you're using, then you would be completing the worksheet for form or for field 15.
And I think it's just important. I think it's important to note, folks, because Brian was absolutely correct because we always get these questions, especially from entities that don't file their taxes. So it's pretty clear and obvious what the number is that you're going to use from your 2017, 2018, or 29 tax filing. The issue really comes down to questions like this and that revenue reporting. Is it gross revenue? Remember the way they're defining it on the revenue worksheet. It is gross revenues minus discounts and allowances. Yeah. It's what most of you would consider net patient revenue. Okay, so they're saying gross revenue, but in our vernacular, folks, it's really your net revenue. So it's your gross charge minus allowance minus discounts. That's the number you're reporting.
Yeah, and if you're a governmental entity, right, we know that typically you have to use your most recently set of audited financials. So another thing you want to make sure you get done. So here's another question, is the net patient revenue still based on prior year's tax return /990 /audited financial statements? And the answer there would be yes. So if the provider received more than 2.8% of net patient revenue in the first round, would it make sense to apply for this round? I think the answer to that is yes. However, you may not, based upon that formulary, once everyone's grossed up to the 2%, if it turns out that there's enough money left over, let's say, to bring people higher than the number that you might have received, then you may get something. But I sort of a no harm, no foul, if I'm not wrong, so to apply for that. Now,
So Scott, maybe we should just perhaps detour and just, because I imagine there's people on this webinar that are wondering how you could, if their goal was 2%, how did you end up at 2.8%? So one of the things we have to keep in mind is that the first distribution, the first round, was based on your Medicare payments,
right,
because that's the information that HHS had available to it at the time. And since their initial goal in April was to get this money out the door as quickly as possible, they used what they had, which was the Medicare payments. So for those providers, and while this will certainly include many EMS providers, it's certainly not limited to EMS, that see a disproportionate amount of their revenue come from Medicare as compared to all of healthcare, right? It is possible that you could have gotten more than 2% of your net patient revenue, or net patient care revenue, excuse me, in that first tranche, right? The difficulty in answering that question as to whether you should apply or not, I agree with Scott's answer, which is there is no harm in applying, so you might as well, is we don't know how many providers found themselves in that sort of situation, right? Because if half of all healthcare providers found themselves in that situation, and those half elect not to apply, they will calculate the add-on based on those that did apply. And in theory, the number can go higher than 2.8%, right? So this is, there are multiple factors here, and CMS is determining the size of the pie. How many people apply determine how many slices the pie gets cut into, right? So without knowing that answer, it's difficult to say whether or not, what the right answer is on where the target number will end up. What I would recommend is what Scott recommended, which is there is no harm in applying, right? Maybe we'll be surprised, right?
Yeah.
But you don't want to regret, you don't want to find out that the number went actually higher than where you were, 2.4, wherever your number is, right? And then find out that you left some money on the table here.
And as presumed, we have a ton of questions. I'm just going to read a couple more and then we'll bounce on to because I think some of these questions may get answered as we get to Wayne's first portion of the presentation. So just what time frame or revenues based off of? And I'm guessing your net patient revenues will be from that last filed year or your last 990. A great question from Matt. If it was mentioned that HHS will use the data submission to verify the 2% loss in revenue, what happens in the unlikely event that a provider has experienced less than 2% loss in net patient revenue?
Yeah, Scott, I'll handle this one. I think we might be confusing two different concepts here. So the 2% number that they're verifying is not a loss in revenue. It's that they've dispersed to you 2% of your net patient care revenue. That's regardless of whether you suffered losses or not, right? So in these tranches, there is this issue of the calculating the size of your distribution. Separate and aside from that is the reporting piece that will occur in February of next year. There, they will look to see whether or not you actually needed the money based on your revenue losses and or your expenses. And we'll touch on this a little bit later, but it is possible that a provider that did not experience a material impact on its business, either in terms of increased costs or lost revenue, might be in a position in February of having to refund a portion of that money, right? Meaning to the extent they didn't need it. However, even in that case, it would still make sense to take the money today and then worry about refunding it 6 months from now. So our worst case scenario, even if your business was not at all affected, is an interest-free loan from the government for 6 months.
All right, and I'm gonna hit one more and then I'll catch the rest near the end. And this one, this is an interesting one. Just we applied for a second round using 2018 figures because at that point they didn't have their 19 tax returns yet, but they do now. And so should that or will that affect the calculation? And I think the answer to that is I would use your most recently filed tax returns. And then if in fact you've had any adjustments to your revenue, your net patient revenue, because you've taken on new business or you've sold the business, that's one other time in which you must do worksheet, the attached worksheet for field 15. So I'm gonna keep rolling on slides here. Brian, do you wanna, or I'll actually, so while HHS recommends that you apply early, as we sort of mentioned earlier, if you've already hit that 2% threshold, then I don't think that there's any significant benefit to applying early, but I would apply before the deadline, and I believe it's November 6th. And one of the things that HHS made pretty clear, and the reason they were encouraging early reporting, was because they're going to have to review all of that information that you submit, and then, of course, process that. And I presume they are going to be inundated with applications from providers. In particular, I think they focused on behavioral health just because of the they sort of mentioned a lot in the press release that the long lasting effects of this pandemic are really having substantial mental health, or burdens on mental health providers, as most would presume. So one of the things that we do know is this isn't going to be like tranche 1 where all of a sudden the money showed up in your account. We think that at the earliest, probably, it's unlikely that anyone will see any money probably before or near the end of November, because there is going to be that vetting process of that financial information. So make sure, this is not the kind of thing where you're going to expect that money to come rolling into your account anytime soon. But as we said, we do think no matter what you received in prior funding rounds, that you should apply. There really is no harm in doing so. So at this point, and we will get to the questions that are still coming in. There are some that have been duplicates, so I've been answering those by typing into the question Q&A session. But we are capturing all of those, and we'll make sure that we put out an FAQ after the webinar. But at this point, I want to hand it over to Wayne, Wayne, as I said, always jumps out in front of that train to help us and really make sure that members understand what the process is. So Wayne's already been on the platform today in the application portal. And Wayne, if I could, would you mind walking us through what you experienced as you went through that process?
Thank you, Scott. Certainly, I will. It's actually been a pretty easy process. Again, very, very similar if you did the round 2 application, where there's a component that's done on the website and then it pushes you off to a DocuSign form. There is a training guide that they have published, and that's what this slide is showing us. They walk you through and show you what this process is going to look like. Scott, if you can jump to the next slide.
Okay.
Here is what I experienced when I logged into our account. It showed that our TIN number was previously validated, and it is still valid from when we did the round 2 application. I have heard that somebody did log in today and they had to revalidate their TIN. Hopefully that's a one-off or a rare exception. But in this, it was just as simple as hitting the get started blue link in the middle of the screen there, which resulted in what you see on the next slide here, which when you did your round 2 funding request, it did this same process. It emails you a code that you then have to drop into this box to get into DocuSign. This is sort of the handoff from HHS to DocuSign. And then the DocuSign document, I skipped down to the relevant part. The top half of the form is your company information that was all pre-populated from the web portal. It asks for some contact information, your name, phone number, address, email address, that kind of thing. This is the important stuff that they're looking for. Line number 10 here, the revenues, that's the gross revenues from your tax return document or other supporting document that you're uploading, be that an 1120, a 990, your government agency, that would be your financial statements. Which year is this for? In this case, we would be selecting 2019 because we have just recently filed our 2019, where at round 2, we used 2018. And in my case, the percentage of revenue from patient care, since that's all we do that. And then revenues, both Q1 of 2019, 2020, and then next slide where you went, the expenses for 2019, 2020. You can attach the 4 documents, put in some direct deposit information, and hopefully you get money come Thanksgiving. I mean, realistically, it is that simple. The thing that took me the longest was to just get the P&L statement showing Q1 and Q2 only, instead of having to give them too much information.
Yeah, and Wayne, we have talked that it really is essentially, when printed out, it's a 2-page, but the second page just says it's intentionally left blank. So only in the government, right, do you have one page that's wasted just for the Paperwork Reduction Act. Anyways, so it really is a pretty straightforward process. And so, you know, Wayne, did you have any issues aside from the collection of the information? How long did it take?
I mean, the thing that took the longest was, as I said, getting the P&L. Otherwise, this information, I had it from CARES Act funding for our state to have a copy of the tax return. So if you don't have this, or you haven't done the round 2 funding, you're going to need your tax return. You're going to need P&L for 2019 and 2020, both broken down by quarter. And that was it. And direct deposit information. And attach them as PDFs. I mean, it was really straightforward. I've used the DocuSign platform before, which is what this gets handed off to. So it's pretty easy, simple.
Yeah, and so I imagine as you're finishing, right, you do the terms and conditions, the attestation, and those terms and conditions haven't changed, as I understand it, since the other, right, either round 1 or round 2, where round 1, most people either signed in or they just were defaulted to have accepted terms. And you, of course, were kind enough to jump on the application window of October 5th. So I think it opened probably at 7 a.m. this morning. And I know Asbel actually, and thank you for that, because I know Asbel, you sent out some updates that HHS published, I think, over the weekend or at some point today, that we were all trying to catch up on right before this. So thank you, Wayne, for doing that. As always, this is like, I think, the 3rd time you've taken the hit for the team and gone out and done that. So we really are grateful for you doing that. So you have until November 6th. There seems to be really, we think, enough time. And I want to answer some of the remaining questions we had before we jump into the provider relief reporting, which is the other thing that has been announced really since the last time we all got together to talk about some of the COVID provider relief stuff. So I did have AM definition - discounts include bad debt, right? Well, if we're talking about your net patient revenue, sort of, if I'm not, unless my financial knowledge is well, actually, and I'm not the most brilliant financial mind, but your bad debt should be captured in that net patient revenue, right? Brian or Asbel, do you have any comment on that?
So it's going to be based upon how you've done your calculation in general. So if you have included bad debt, then you continue to include bad debt. If you excluded bad debt, then you continue to do that as well. A lot of this stuff is developed on the definition as hospitals have done things, which they've always included bad debt. And that is simply because of how they get reimbursed for things. So you need to stay consistent in your methodology on how you're doing that, because remember, if these are audited financials, and that's probably what's happening when you look at the discounts. So I would just continue to keep using that same formulary.
Okay, we had another question.
We're still actively trying to collect it. It's not bad debt. So, you know.
Correct. I would say bad debt shouldn't be in that calculation, but I do know that there are some entities across that don't collect. They write everything off to bad debt. They don't try to collect anything. So that's why I'm kind of being vague on that piece. If you've got concerns about it, let us know the question. We will work with you offline about that to make sure that you're using your calculation correctly. But typically you don't include bad debt, but you can't really make that overarching statement because there are some of you that do. You don't collect on it, so it really should be in your discounts.
Right, and Medicare defines bad debt as you're no longer trying to collect it at all, period, right? And so, and I know a lot of times this really does, Asbel, you make an important point, because a lot of times I'll hear from people, well, we collect X percentage after bad debt and contractual allowance, and I think, shouldn't that be 100%, if I'm not wrong? Because if you've taken off your bad debt and the amount that you didn't expect to collect, well, then it should be 100%. So next question, our collection company had a hard time collecting money in late 19 for several reasons. However, they made up for it in 20. Our financials look pretty bad for 19, but better in 20, even though our transports decreased by 30% from April to May. So we might have a challenge showing that we lost money due to COVID. Volume can show, but not net revenue. This is the instance where you want to go in and utilize that worksheet that you have to submit. If I'm not mistaken, that's exactly the reason why they're saying from your 2019 filings, if you've had a change or a significant change, you'd want to be able to show that. I understand that you might have collected that money in 20, but I think that should tease itself out if I'm not mistaken.
Well, if you're accrual based, correct.
Right.
If we're talking about a company that's using cash based, then the concern exists. But again, let's just be precise here. The amount that you would get in tranche 3 is initially calculated based on your 2019 revenues, right? Whether or not you can keep the money is a function of whether or not you actually lost money compared to 19 to 20. So, but that issue doesn't really come to the fore until February, and it also includes the notion of increased expenses. So,
no, good point. For providers that already received 2%, when do you suggest the provider apply? How near the deadline, and what's the disadvantage or advantage for applying now? Really, I don't know, Asbel, if you want to field this one, but it's really, there is no disadvantage to applying early, I suppose. But certainly there's no advantage to applying early if you've already gotten the 2%.
The only way that there would be an advantage, folks, and this is all I'm saying here, is remember we're talking about the floor. So if you did not apply, if you rejected the funds, and are you, for instance, several of you I have talked to that you were in a different situation in 2018, had not currently filed your 2019, you now have, so you want to update, and that could actually make a difference in you getting to the floor. Yes, I would strongly suggest the earlier you get in, the better, because remember how the formulary works in 2 parts. First is bringing everybody to the floor, to the floor. Once you get to the floor, taking the rest of it and equitably distributing. So it is within HHS's purview that they could actually say, we're going to go ahead and send out 2 disbursements. Don't quote me on this because I don't know if that's what they're going to do, but there's pressure to get money to those providers, especially like behavioral health, substance abuse centers who have received nothing at this point in time. So they could go and say, we're just going to go ahead and start releasing funds to people that got less than 2%. Let's get that out to them. And then we will then, after all that is done, once November 6th is done, then do the equitable distribution. So in a long story short here is if you are less than the 2%, absolutely get it in. If you are not, then timing really, in my opinion, you can wait until November the 5th or November the 4th to get it in.
Right, because they're not necessarily.
Please don't wait until November 4th. Just get it in November 1st at the latest. But look, if everyone jumps in early, they can distribute it earlier, right? But Scott's answer, I think, is the correct one, which is there's no disadvantage to applying earlier, and there's a potential advantage if you're not already at the 2% floor. Right.
All right. I love the next question from Alan. The current form in process address only Q1 and Q2 of 20. In our case in South Texas, Q1 and Q2 were actually not that bad. The big hit came in Q3 in lost revenues and additional expenses. Do you think we can expect more help with that? And I'll field that to well, actually all 3 of you.
Well, Alan, if you know any of us and our personality, if you honestly think we are going to be okay with, while we are appreciative of what they've done with this 20 billion allocation generally, it is absolutely not near what this industry needs. And to your point about Q3, and then potentially there could be an impact with the second wave coming in for Q4. So advocacy is not over, and you are absolutely correct that there is going to be a lot of work continue to make sure this is not the end of the help for the industry.
Yeah, one of the things that we've been suggesting for folks, and Rob Lawrence, our communications chair, actually suggested this, was to start sort of the after action report now, right? In other words, make sure that you, just like we're talking about, I know all folks I think on the webinar are involved in cost collection in some form or fashion, right? We've been talking about cost collection now for probably 24 months or even more, really. And this is that part where you need to be really clear about where your monies are being used, where your revenues are coming from, and that's consistent with what you're going to have to do at some point in the next 4 years anyways. So this is one of those times where, and recognize, as Asbel pointed out, we're going to continue to advocate, but just imagine had we had a solid cost collection process in place prior to the pandemic, how easily it would be to get really solid data about how this pandemic has impacted folks. That's why we're encouraging folks to get involved and be using Amber and doing cost collection really now, so that when we do it, one, at this point, I'm not convinced this thing's ever going to end, but number two, should we have a second large scale national public health emergency like this, I would like for us to have data that we can actually put in front of lawmakers to say, this is what we need, this is why we need it, and here's, why that is critical for us, because I'm not certain that, while I've heard some folks say that they've gotten more than their 2%, I don't know that 2% was the right number. So I think it's important that if you haven't already done so, again, I know a lot of you on this webinar are the people who are engaged, and probably 10 providers who aren't on the webinar because they're busy running their service, or maybe they don't think that they're going to be able to make a difference. Make sure that you ring the bell and start hollering to get those people involved. We've been told by the IRS, we've been told that the IRS will treat this money as income. Is this taxable income?
As of today, that is well, yes and no. So it will be treated as revenue, no different than any other patient care revenue you get. Whether or not it's taxable income requires a much deeper analysis. Keep in mind, on the reporting piece of this, it is HHS's intent to look first to expenses and then to lost revenue. So if the total amount of the provider relief funds you receive are equal to your increased expenses, yes, it would be treated as income, but it would be offset by a corresponding deduction for those expenses, meaning it wouldn't change your taxable income. To the extent it's replacing lost revenue, logically it would be treated no different than other revenue. And to the extent you are taxable and to the extent you have taxable income, it would be taxed as such. So that is one that we strongly recommend that you treat, you discuss with your tax professional, but you are correct. The IRS has said that it will treat this the same as all other revenues derived from the operation of a business.
Yeah, and then the last one before we move on now to these reporting requirements is, are you eligible if you received a PPP loan? And the answer to that is yes. So those are distinct things. The PPP loan is different than from any of the CARES or the provider relief fund. So you are eligible and should apply in both, even if you received a PPP loan. Just actually, and I'll do one more and then we'll hit the rest at the end. Going back to the worksheet, reporting quarter 1 and 2, if we are on a fiscal year 10/19 to 9/20, would we change our Q1 to October to December of 19? I see Asbel shaking his head. So
no, they're very specific. This is calendar year. So that's a good question to maybe ask, but they are pretty specific. It's calendar year.
Okay.
Yeah, you would be reporting your data for your third and fourth quarter of your second and third quarter of your 2019 fiscal year, which happened to occur in the first and second quarters of the 2020 calendar year.
Yeah.
And the application does specifically say 2020 quarter 1 and then defines it as January 1 through March 31.
Oh, that's fantastic. So very clear, very clear. All right, great questions from everyone. High engagement, really appreciate it. So the provider relief reporting, we know we've been hearing about the obligation for providers, for folks to have to report how they use those monies and or those lost revenues attributable to COVID. And so what we do know, and we've heard since the last time we got together on one of these COVID-related webinars, are that, of course, we knew that money had strings attached. We knew that it had a very specific usage. So what we do know and what has changed, of course, was initially, I think the number was if you received 150,000, but that number or that floor has been lowered to 10,000. So if you receive provider relief funds in the anywhere from 10,000 to $499,999, you will have one level of reporting. Anything over that, you will have a second level of reporting. All right, and those, you basically signed off to all of that when you accepted the terms and conditions of the money. So we now know a little bit about, and the website's there at the bottom, about what your obligations are going to be from a reporting perspective. Of course, it's always helpful to know what these are as you're getting ready to apply for another round of funds. So these post-payment reporting requirements, and I don't know if we'll see a change to these following this release of the third round, but my guess is no. The goal is, right, to make sure that you are able to, prevent, prepare, and respond to coronavirus, as well as offset those lost revenues. So, not a lot of detail in the publication that was sent out, or the press release that was sent out by HHS. But you will have to, they did give some broad discussion about what will be required. Those healthcare related expenses that were attributable to COVID-19, so those both general and administrative expenses, as well as the operating expenses and lost revenue. So year over year net patient care operating income that was not reimbursed by some other source. So that's important, right? They're looking to prevent that double dipping. So in those post-payment reporting requirements, there will be the initial section of that demographic information, the reporting entity, the tax ID, the NPI, the fiscal year end date, and then the tax classification. So whether you're a corporation, an LLC, or a sole proprietor. And then you will go into those expenses attributable to COVID-19, 2020 only. And I don't know what will happen, as I presume most of us will still have expenses related to COVID once we get into 21, but we'll pass that or cross that bridge when we get there. So those expenses on G&A, as well as healthcare related expenses. So they do go into just a little bit of detail about what those are, being mortgage and rent, insurance, personnel related expenses, those fringe benefit, lease payments, utilities, and then other G&A expenses, as well as the healthcare related expenses. So additional supplies, PPE, equipment, you have to buy extra whatever, whether you had to buy additional equipment for, let's say, decontaminating ambulances, any information technology equipment that you might have needed to invest to. So say, for example, for people working from home or other communication type tools that were IT-based facilities, if you had expenses related to COVID to, let's say, putting up partitions or other additional cleaning, etc., and then other healthcare related expenses. And when we get more detail on this, we'll provide subsequent, and I'm going to bet money that Wayne will probably be our guinea pig again when it comes down to having to report. And then we'll go through that step by step so that folks know what's going to be required. The lost revenue requirements, they're looking for a quarter by quarter total / net revenue, net charges. Okay, so, but they want that broken down really by Medicare Part A, Part B, Medicare Part C, Medicaid, commercial insurance, self-pay, and then other. And then the last section is that other assistance received. What they're looking at is what other assistance did you receive outside of the provider relief fund? So in this instance, if you got a PPP loan or you've got some local or state monies that you got separately or independently from the provider relief fund, then you would want to report those, or that's where you would report those there. Any comments from my co-presenters so far? No? All right. Then there are some non-financial data requirements. Those are those personnel metrics, the patient metrics, so the number of maybe transports that you did, as well as facility metrics. I think those are really getting at the institutional providers, so those hospital-based providers, how many beds did they have open? That really wouldn't apply for us. And then they do want to know if there was change in ownership during the reporting period. The important part for this is that there's no double dipping, right? Just as the same as with cost collection, right? You'd only report stuff in one place. Here they're looking for just revenue monies and how they were spent that weren't reimbursed by other sources. So those funding, the funds cannot be used to pay expenses or losses that have been reimbursed by other sources, right? So really, that is repeated multiple times in their guidance. So it's important that you have very clear accounting practices so that you can show, in the event that, let's say, you need to get audited, you want to make sure you're doing it right? Because if in fact you were in a position that you had to pay those monies back, that could be problematic for a lot of folks. Don't reinvent the wheel. As I mentioned earlier, you're in this process right now, and if you aren't, you should be in this cost collection process. There is a cost collection structure. Yes, there are some different definitions from cost collection to some of the provider relief fund stuff, but it's in the same vein. Make sure that you're using that same process. Expand those cost tracking to identify particular COVID-related expenses. And then same with in your accounting software across all systems. One of the things that we've told people are, to the extent that you may have staffed additional units or you might have done things differently because of COVID, you just want to make sure that you're able to identify that. Before I close out, I'm going to look at questions in a few minutes, but there are additional resources on the AAA's webpage specific for the COVID page. You can go to the AAA's ambulance, www.ambulance.org/COVID-19, and you'll find resources and links to all kinds of material that can assist you. On the reporting requirements, gentlemen, do you have anything to add before I look to see what we have for questions? Nope.
I mean, Scott, there is one thing I'd like to add.
Yep.
Is when you start doing reporting for this and your PPP loan and state CARES Act funds and so on, you have to look at what each is allowed to be spent on, right, and attribute accordingly. So use the most restrictive funding for those expense categories first, then move on to the broader ones. Because, for example, the state of Wisconsin in one of their earlier rounds incorrectly took into account all of your PPP funding to dismiss lost revenue. Well, you can't use PPP funds against lost revenue. So you have to very carefully account for what funds are you using where. And quite frankly, the later in the year you do all this calculation, the more pieces of the puzzle you have to put together a complete puzzle.
Yeah, that's a great point, because there are, depending upon where you received the funding, there were some restrictions upon the funding. So if you can, take a step back, look at all your total expenses, look at all of the potential impacts to revenue, and then make sure that you're accounting for them appropriately. That's perfectly fine. There's nothing inappropriate about that. Just make sure that your full team, in particular, whoever manages your finances, is on board and understands what those restrictions are. So if you've received funding from multiple sites, make sure that you're going to those terms and conditions to make sure that you're using them consistent with what the terms and conditions are. The last thing that you would want to do is have to pay some of those monies back. And one of the things that we've gotten asked a lot is, are we going to have to pay monies that aren't used back? There is a likelihood that if in fact you receive funding for which you did not have a corresponding COVID-related expense or lost revenue, that you may have to pay that money back. So make sure that you can clearly, to a level of potentially being audited, that you can show that. So any final words before we close out?
Scott, there were a couple of questions that made their way into the chat one. So if you want, I can read them quickly.
Sure, go for it.
So the first question was whether or not patient revenue would be included in the would include contractual revenue derived from either event standbys or FEMA responses. Anyone want to tackle that one?
Asbel, you want to tackle that one?
I'm sorry, I'm doing two things at one time. So would patient revenue include contractual revenue from event standby or FEMA response revenue? So remember, Cynthia, the way that they're looking at revenue, this would absolutely, if it is related to patient revenue, then yes. And remember too, when you're doing the reporting side of things, you're going to have to include all FEMA funds, anything that was related to your service that dealt with net operating revenue or patient revenue. So absolutely. There's another question in here as well, where states are interpreting expenses, and they're not interpreting some of the funds that are being directed to them from U.S. Treasury through the Coronavirus Relief Fund, which was commonly known as CRF. That some of them are interpreting that can only be utilized for expenses and not lost revenue. Unfortunately, Treasury has not given very specific guidance. They've given very broad guidance to states to allow them to use it. Absolutely, there's three terms that the U.S. Treasury has given to states and to local entities that have received those billions of dollars in funding. and they have been used for coronavirus fund, used to offset budgets that were already allocated for, which technically, sorry guys, I'm so blunt about this, you kind of know, that is revenue. And so, however, unfortunately, because you're dealing with governors and states and mayors, they're interpreting differently. So you're going to see some states that are going to allow you to use funds for lost revenue, some that are only going to allow you to use it for expenses. They're going to set application processes with that. Unfortunately, you're going to have to go by the guidelines that the states are there. You can try to work with Treasury to get them guidance on that. I've just learned probably what you want to do is just go through the application process. If it's expenses they're using, utilize your expenses accordingly, and then you would use these CARES funds to maybe augment your lost revenue piece and kind of work through the process. The one thing you need to understand though is with the cumulative funding received from everything, if it is more than what you can allocate, you're going to have to refund that back. If it is less, then you're good. But unfortunately, that's kind of that is the issue, and I know there's lots of people experiencing that right now because of that interpretation. So the Treasury gave great broad guidelines, which is nice. The problem is that leaves it open to so much interpretation on the local levels.
But Wayne's earlier point is a very important one. So where a state has issued money that's directed specifically to cover a particular expense, these funds can be used for much broader purposes. And HHS has designed this in a way where it's specifically basically designed to be the last dollar towards any particular budget item. So to the extent you've previously allocated some of these funds towards a specific expense and then got grant money for it, we may need to go back in and change our allocations. So Wayne's point about using something for the most targeted purpose first, and then looking at this to wrap around, right? Because this also can include the lost revenue piece. So your accounting may not be static in the sense that if you get money for something that you previously applied provider relief funds towards, you may have to back out those provider relief funds, plug in that grant money for that, and then look at the other pieces you have there. So this is the last piece you do after you've allocated everything else. So we have one last question, which is along these lines. So in this case, the state of Arkansas made a supplemental payment to all medics in the state. Those dollars were paid to the company and 100% had to be passed on, presumably in the form of higher wages to those employees, right? Will this be considered as additional payment to the EMS company? I would argue it wouldn't be revenue there because, or to the extent it's revenue, it was then matched by a corresponding expense on the labor side. But certainly that money I would allocate first towards your increased labor costs, right? And then to the extent that didn't fully compensate you for the increased labor costs, you could then plug in your provider relief funds to bring that up to zero or to net that to zero, right? When you do your final allocation. So again, this is much broader in terms of what it can be used for than many of those state targeted grants. So be mindful of that.
Actually, and a couple of other questions that came in, and we'll just stay on to finish these if it's okay with folks. And if you have to drop off, certainly a copy of the, or a copy of the slides, as well as a recording of this program. Amanda, I'm sure will be sending out a link after we're done. Is there somewhere to look up on a website where or how much we received from the stimulus? I know we received the first stimulus and it's very close to the percentage of Medicare that was being used. I don't believe we received the second deposit, but our bank account info has changed and I'd like to be sure. Asbel, do you want to field that one?
I'll handle it. Yes, you can go on the HHS Provider Relief website and get the sum total of the amounts that your company has received.
Okay, perfect. Well, thank you to Wayne, Asbel, as well as Brian Werfel. For those of you who, and all of you, frankly, who attended, I know there was a couple hundred folks on the program, so we really appreciate it. Just be sure to know that if you need any one of us, you have questions, you can either go to the AAA's website or you can email any one of us, and I'm sure we will get you the answer. We know that it is, information comes fast and furious, and as always, we do our best to stay in front of that and answer your questions and provide as much support to the AAA members as we can. So with that, as I'm sure Amanda will be sending out, I'm sure a copy of the slides as well as a link to the recording. And then I'm sure also you're a place where you can submit your questions as well. So I want to thank you. An unusual time for us to have a webinar at 11 a.m. on Eastern time, but thank you very much. And I don't know if I'm handing back to Amanda to close us out, but if not, I want to thank you for your attendance and make sure that you renew your membership. Thank you.
Thanks so much for that, Scott. Just to reiterate, today's slides, as well as a recording of this session, will be included in tomorrow's Daily Digest email that's distributed to all members. So please check your inbox first thing tomorrow morning for a copy of the slides as well as the recording. Thanks again to the 253 people that joined us, and we hope that you have a great rest of your day.